Marc Franklin. He's Deputy Head of Multi-Asset Solutions, Asia Manulife Investment. Marc, thank you so much for joining in. Pleasure speaking with you. Let's get your sense first about Jay Powell's comments that inflation is going to be a risky factor. That is expected, isn't it, if you are going to go into a tariff war? Why has that one comment spooked the markets in your view?
Yeah, good morning. The market was looking for some sense of striking the right balance between the perceived and potential impact on activity versus the perceived and potential impacts on prices. And the market probably took the view that Jay Powell is leaning more of his focus on the perceived and potential impact on prices or inflation. Whereas in effect, if you look at the bond market reaction to his comments, actually the front end and the whole of the bond curve was pretty becalmed. And their view, therefore, the bond market's view is that the activity side of the equation is more important. And what you're likely to see is a more significant downwards impact on activity that offsets and is more important than the initial impact on goods prices as a result of higher tariffs.
Hi, Mark. Alex here. I'm asking about treasuries and I'm asking about dollar because it's not very often that you see the dollar move down at the same time as risk assets moving down. And we're talking about a situation where there is selling, in fact, by foreign investors in US Treasury on the long end. What are the implications in the near to medium term of those flows? And in the context of that, you see that there is buying in the Indian equity markets. I'm just wondering if fixed income will find takers in Asia, in India, equity will find takers based on the movement of capital.
That's a great question. It's really pertinent as well. If you look at all US dollar assets, whether it's equities, bonds, currency, there's significant foreign ownership. And what we're seeing is some retrenchment of ownership by European investors, by Japanese investors, and by Chinese investors, but for different reasons. In the case of European investors, the heightened degree of policy uncertainty and to some extent local distaste for what the policy shift has been is encouraging institutional investors in Europe to repatriate some of the overseas ownership and to redeploy some of that into local markets. Now, we don't necessarily think at this stage that we can conclude that this is going to be a permanent and progressive unwinding of foreign ownership in US assets, but there's going to be a marked shift down as an immediate reaction. In the case of China, potential lightening up of US Treasury positions, it's more as a result of an acute US dollar shortage, and it's almost forced selling, not as a result of a reaction to the Trump administration's policies. Now, what does it mean for bond markets such as in India and so on? You have to look at who the sellers are. And as I said, if you're a European institutional investor looking to de-risk to some extent your US asset exposure, you're probably going to redeploy that in your local markets, take less currency risk, take less repatriation risk. So it's not necessarily the case that those flows are going to find their way into other overseas markets. It's more about bringing it home to some extent first.
Mark, just one question. There are a lot of reports, right, about, I think WSJ is saying that US officials are planning to use negotiations with about 60, 70 odd countries to tell them to disallow China to ship goods through their countries, maybe to the US or otherwise. But at the same time, we are seeing enough data which suggests that China is making a pivot out of US to other countries for business, right, to Canada for oil, etc. How easy would it be for the carrot and stick administration currently, a strategy that the Trump administration is using to tell countries to quote unquote isolate China?
It's going to be difficult, but if you look at the longer term trends, indeed, the US as a share of China exports has been progressively falling over many years. And actually that's as a result of China's success in cultivating other overseas markets. Now, with respect to looking for alternative destinations for exports, the Canada-US trade situation is still going to require US permitting of that transshipment route. And so it's going to be difficult for China to fully cultivate a more accelerated shift away from the US, even if goods ultimately find their way into the US market. Now, coming back to whether the US administration is going to be able to convince other parties to effectively choose between the US and China, it's really going to require a carrot and stick approach. What is in China's favor is it is a huge market for those other countries' own exports, even though most countries do run current account deficits with China, albeit much less so than the US. So it's really going to come down to what can the US offer as a means to offset what those trading partners would lose by effectively shutting off those transshipment routes.
All right. Mark, just a quick view on emerging market risk assets then. Do you think, as you pointed out, of course, there is this sense of bringing money home, bringing capital home, and not wanting to take that currency risk? In that context, I think if some of the noise gets separated, you're talking about earnings once more, and I want to know what you think of the expectations for India when you talk about your strategy globally.
Yes, I mean, if you look at the structure of the Indian economy, it has a high weighting towards domestic economic drivers and therefore less sensitivity to a marked potential downturn in global trade dynamics. And as a result, you would think, all other things being equal, that the earnings cycle should have less sensitivity to what is happening globally. That being said, though, we know that there are significant offshore earners in the Indian equity market that derive a significant portion of their earnings in US dollars. And if the US dollar continues to weaken, albeit at different paces in the different currency crosses, that may also have its own feedback loop, which could to some extent mitigate any of that resilience. So lots of movers and shakers. I think what this calls for is not just a country or regional view, but it's also a sectoral view. You're not only looking for markets which have a greater degree of domestic drivers, but also those sectors themselves which are deriving the bulk of their earnings from domestic sources rather than offshore sources.
Interesting. All right. Yeah, so then IT is something to watch very closely. Thanks so much for joining us this morning, Mark. Pleasure having you.